Okay, good afternoon and welcome. It's a pleasure to see so many of you here, and to everybody, happy Valentine's Day. Yeah, great day for everybody to come out, so it's a pleasure to see all of you. Gentlemen, I don't know what's going on, but I've had some rumblings at the front door. Oh, thank you very much for the rose. It's my first rose of the day. Anything I can do to help you out, gentlemen, just let me know. I've also had more man hugs than anything else today because the men were complaining, where are their roses, where are the chocolates? So I was giving out a disproportionate amount of man hugs, something that I'm not totally good at. But anyways, my biggest man hug award goes to this man right here, who probably gives the largest man hug you've ever seen. And for sure, he deserves a rose. There you go, sweetheart.
No. Oh, I lost my chair. So, gentlemen and ladies, the amount of money that we've spent with this individual from the guy's side, I accept this on behalf of all males here.
Yeah. Wow, there we go. There we go. Thank you. So, we have a few people with us today that I would like to introduce. One is right here, and with her mouth full. My timing is always perfect. This is Laura Hind. Maybe you could just stand up for a second. So many of you have met her. She works with all of our clients in regards to your financial plans, your estate plan, and making sure that that process, everything that you've said in your will, is actually going to happen exactly the way that you think. So many of you have already met her. I encourage those who haven't met her to certainly pick up the phone and contact her. You can get the contact information through me, or it's on our webpage as well. I have two special guests that I had to bribe to get here today. Two of my three children are here. First of all, this is my lovely daughter, Montana. Montana, maybe you could just stand up. Happy Valentine's Day, darling. Yeah. And this is Chase Gordon. Hey, buddy. I just pulled you out of school because I think you'll learn a little bit more here than you are going to in school. My oldest boy couldn't make it. He's 18 years of age now, hard to believe, because when I met most of you, I was still single and didn't have children, but he's at the Beatty School of Business out at SFU, and he's playing junior hockey. So he's in the middle of midterms, and he starts his hockey finals next week. So he's not here, and if he was, you'd just wonder where he came from anyways, because he's about 6'1". So his problem is, though, he's still only 155 pounds. So got lots to talk about today. I know there's lots on your mind. Had some interesting comments, and people are bringing me articles. So thank you for doing all of that. So I think I'll dive right in and get rid of the disclaimer, which is mandatory from our compliance department, but I will read it out. The comments and opinions expressed herein are the result of the work done by Verus Wealth Management. They may differ from the opinions of Scotia Capital. It's a good thing. And should not be considered representative of Scotia Capital's beliefs, opinions, or recommendations. This information, including any opinions, is based on various sources believed to be reliable, but its accuracy cannot be guaranteed. It is for information purposes only and is subject to change at any time. I always like to start out these presentations about, talking about what's in the news. Never thought ketchup was going to be worth $28 billion. Don't know if you heard, but Warren Buffett decided to step up to the plate, buy Heinz for $28 billion. So you can be rest assured that all the money managers that like to follow Warren Buffett and emulate what he was doing are really wondering if they had a position in that stock. I think what was more in the news this week was the State of the Union address. How many of you saw the State of the Union address the other night on television? You probably know what I mean. But for those of you that didn't get the opportunity to view it, I thought I'd share a few moments with you. I was busy making my teenage children dinner as I was watching this, and they are incapable of helping me. So I was interrupted at certain points. But for those of you that did see it, How about this guy? John Boehner, the Speaker of the House. I mean, what an unbelievable performance. You have the Vice President of the United States standing up every moment. We're going to increase minimum wage. Boehner. We are going to make sure that every young American has the opportunity to go to preschool. Boehner. It was so painful, I couldn't believe it. So, for those of you that missed it, I just got to show you what it looked like. Is it too difficult to tell that he's a Republican?
I think the Tea Party glued him to a seat.
Yeah, I think so. I think so. Really interesting. I just couldn't believe it. I was in shock. What a contrast between the two. And then how about this one? Did you see when they just came right in on Tim Cook? And Obama's gleeing from ear to ear saying, they're going to make Macs in the United States. Tim Cook's going in the back of his mind, sure we are. Sure we are, President Obama. Because the real question that Mr. Obama should have asked Mr. Tim Cook was, well, considering that in 2011 you made $34.4 billion in profits, and worldwide you paid $3.3 billion in tax, which works out to less than a 9% marginal tax rate, and you paid most of that internationally, and none of it went back to the United States. That's where the real problem is in the United States. It's not about making the Mac, it's about where you pay the tax. And they're just not paying the tax in the United States. Where is it going? It's going next door to Nevada. It's off to Ireland and then to the Caymans. They've got it figured out. But that's very in a sharp contrast from Walmart. Last year, Walmart made almost $25 billion, paid almost $6 billion in taxes. They've got a marginal tax rate of over 25%. Big difference. So it's no wonder that Tim Cook was in the audience at the State of the Union address with a big smirk on his face, because he knows it doesn't matter where he makes them. He's just not going to pay a lot of tax in the United States. And then the beauty of it is he lobbies the president to bring back all that money offshore that he's paid no tax on and bring it back to the United States for future growth. What a corrupt system. Then how about these guys? This was incredible. We're going to bring the troops back home. Watch the guy on the left with all the stripes. Unbelievable. Watch this. Yeah, we're going to bring back all the troops. He gives a real big clue. Okay, boys, time to stand up. Unbelievable. Unbelievable. So, I want to start out by giving you an overview of what happened last year, talk about some of the results that we've happened to achieve, and then I want to get into what we see happening in 2013. So what I did is I did an interesting exercise. I should qualify that. I got my staff to do an interesting exercise. And you'll notice that last time you were here, you all had envelopes, right? And you had your performance reviews. And you were all naughty because you all opened them and you were comparing them at the table. This time, I got them in my hot little hand. So I thought it would be interesting to find out from January 31st of 2013 what your annualized rate of return would have been over 3 years and since inception. Well, thank goodness I had Cindy. Thank goodness I had David, because they managed to pull that together very quickly. If I would have done it, probably still wouldn't have happened. I think my daughter's most painful thing in the world, and my girlfriend's most painful thing in the world, is watching me text somebody. I try to explain to this younger generation and to David to say, do you know in 1985, 1986, it was just an amazing breakthrough? The fax machine came out. So I wouldn't have to go and sit at the Hall's kitchen table to get them to sign anything anymore. I didn't have to go to the Wolfrey's house. I didn't have to go to the McNeil's house. Now, my kids are saying, what's a fax machine? So, Cindy, David, thank you very much for putting this all together. It's actual numbers, ladies and gentlemen. Here's the worksheet. And I think if you take a look at the numbers, and I will make sure these are all alphabetical order, Jennifer, I haven't messed them up. What we'd like you to do on the way out is pick up your envelope. For those of you that have to leave early, no problem. We'll make sure that we pop it in the mail for you. So, if you take a look at the average rate of return in this room, it was 9.2% in the last 12 months. The TSX, 1.8. We outperformed the market by 7.4%, or almost 400%. You're welcome. If you look at it over 3 years, and I think when you look at the 3-year number, you have to put that in context, because last year, the S&P TSX did 4%. The year before, 2011, it lost 9. Net, still down 5. And over 3 years, we're still at an 8.2% net rate of return to you after fees. The composite's done 4.6. We've outperformed it pretty close to 2 to 1 by almost 80%. So I think things are going well. You're happy, and when you're happy, I'm nervous. When you're nervous, I'm happy. Okay? So we'll talk what's going on here in a moment. So based on some of those numbers that you see, we're proud to announce that Verus Wealth Management for the 3rd year in a row has been selected as one of the top money managers in the city. It's only a 2%, less than 2% of all wealth managers get this award, so we're very happy to receive it for a 3rd year running. Thank you. So again, I said to David, David, do me a favor. I said, every year, the Globe and Mail ranks all of the best performing mutual funds in Canada. I said, take that list, put our mandates on it, make it dead even, okay? Make it dead even and make it a management expense ratio of 2%. So, if we look at the list, our Verus High Income and Verus Dividend Growth over 3 years led the pack. And our Verus High Income by a wide margin, making it the best performing mandates in Canada. What I like to see is the consistency of those returns. The more consistent they are, the less phone calls we receive. We like that. The Verus North American Dividend, okay? Again, solid performance. Our defensive income. Table number is that defense? Oh, table 13. I'm speaking to you now. This is, yeah. Why did they put you way back there? Are you on the bad list or something? You're too far away. Yeah, no question. I don't expect you to be able to see this, but it'll be on our webpage. Obviously, the defensive income has been incredibly consistent, and it has a beta of 0.18, which means it has 82% less risk, and it's outperforming the market each and every year for the last 3 years, by 7 full percentage points. What I find really interesting is Verus Canadian Strategic Value, which was managed by Foyston, Gordon, and Payne up until 3 weeks ago, when I fired them, actually made the top 10 list. And we're firing them. We fired them. We'll get into that in a few minutes. But what I find interesting is, do you think any of these managers are going to fire themselves? Not a chance. And just so you know, I thought of something when I looked at you, Brooke. In terms of these numbers, for those of you that have just come on with Verus Wealth Management in the last 4 months, you're going to really love your performance numbers. Okay? I just want to say that's going to be really hard to repeat. And I also didn't annualize those numbers, because if I took all the new clients in the last 3 to 4 months and I annualized their numbers, it would have skewed the average numbers in this room. And you know that I would not want to do that. So let's just talk about a few things here right now, and I'm going to give you a little highlights on the portfolios. Verus Dividend Growth Fund certainly has had a great run. And we have been so proactive in managing this mandate. Think about in 2011, 2012, we were 34% weighting in telecoms. The stock market's weighting is 10%. We had 3 times the weighting. In the last 3 years, we've gone from 0% cash to 30% cash about 6 times. We made a huge call last year, which I thank you that very few of you noticed. Thank you. Appreciate it. That means you're not going online looking at what you own. You're trusting me. Thank you. But for a 6 to 9 month period last year, in this mandate, you owned 0 banks. Not one. I'm just here to say that I'll bet you that there isn't another portfolio manager in Canada that would underweight the banks, considering that they represent 30% of the Toronto Stock Exchange. We realize it's a call. And you're either right or you're wrong. And we got to be right more often than we're wrong. We get that. Or else you're not coming for lunch anymore. Okay? Got a great group. Obviously, things are going well. Look at that call. So we decided to step up to the plate at the end of the 3rd quarter and buy some banks. We bought Royal Bank in every single one of your accounts for $52. Guess where it is today? 63. We're up 20%. We're up 12% on BMO, up 15% on CIBC, because we purchased those at the exact right time. But we also have a 19.8% weighting in banks. We are still almost 11 full percentage points underweight banks. Same with the high income. These numbers are off the chart. Defensive income. Okay? Solid performance. Verus Balance, there's nobody in this room that owns this mandate. I only have 2 clients that own it. It is about as boring as you could possibly get. So the reason why, it has a high degree of bonds, and we'll get into what I think about bonds one more time. Verus North American Dividend, okay, that's been an unbelievable long-term performer for us, and this is thanks to Juliette John. Juliette John, as many as you know, because we sent you out the correspondence, after 18 years, she left Franklin Templeton. She left Franklin Templeton because she got tired of the bureaucracy. She got tired of not being able to add as much value as she perceived that she wanted to, because she was in administrative meetings that were lengthy and very repetitious. So she made a bold move. She's going out on her own. 6 weeks' time, she will start up Iris Capital Management. She'll be managing that money from Calgary. She only wants to manage $200 million, as opposed to $3 billion. $200 million. So, I think it is in our best interest that the second that she opens up shop, because we've all been with her for over 12 years, and she's delivered for us time and time again, wouldn't you agree with me that it makes sense to move with her? Okay. Well, I'm going to make that call for you. Okay? Because on day one, We're going to give her collectively from Verus Wealth Management, we're going to give her $55 million. We will be her largest account from day one, and we will be her largest account until she retires. And I think it's wonderful to be a big fish in a small pond with an investment firm that manages it like a boutique. Our Verus Advantage Equity is more commodity-based. It had a decent year last year, but 50% of the portfolio is in commodities. I'm going to get into the Verus Canadian Strategic Value and the new manager and why we changed in a few minutes. But obviously, taking a look at our U.S. opportunities mandate, we also did change that manager. It was managed by two different individuals at Foyston. Net, the number's not bad when you compare it to the Canadian marketplace. We made this call, and many of you didn't agree with this call. I said, we need to shift some of your money into the U.S. Well, isn't it interesting that the U.S. market from the lows in October of 2012 is up almost 40%. Huge run. Our number is 16.68% total return to the end of the year. Okay? The market in Canada has done 4.6 over the same time frame. So it was the right call. The challenge with the portfolio manager is they get 40% of the portfolio in cash as the market was rising. So every day I would phone up Mo and say, Mo, what's going on? We got to invest. We're getting left behind. And they kept saying the fear of the double dip recession. I'd say, what happens if you're wrong? Well, they were wrong. That's why we replaced the manager. Our Verus International Growth Fund, managed by Tracy Stauffer, out of Santa Barbara. Santa Barbara is owned by Nuveen. She's now got more support over at Nuveen Capital. We've got a great number right out of the gate. We started this portfolio in the summer last year. We're up 13.52%. We're ahead of the EFA index. And when you compare that number to the Canadian stock market, again, people said to me, Ken, why on earth would you open an international mandate when we have the great European debt crisis? And I said, well, it's the same thing as when all of you in this room bought Bank of Montreal on March 9th of 2009 when it had over a 10% dividend yield. Things are on sale. And again, that's why when you're happy, I'm nervous. And when you're nervous, I'm happy. Again, it's that contrarian view that I've had over these years, and I'll get into that view a little more. I think it's important for you to understand in our business, we call it skin in the game. When I do the due diligence with Juliette John, when I look at Janice and I look at Warren Wischel, who manages our new mandate, I get to look them in the eyeballs and say, Wayne, where is your money? And where is your firm's money, i.e. your staff's money? I want to know that everybody that manages our money, that their skin's in the game. And I think it's important for you to know that my skin's in the game as well. Only challenge with that chart is the first number at the bottom used to be a 2. But then again, that's what divorce will do. I can take any stock market correction, no problem. It's pale in comparison, let me tell you. So, I don't own exactly what you own because at 54, 55 years of age, I don't have time for defensive income. Okay? I don't want to risk. I want to deliver superior risk-adjusted returns. But I'm looking for a little more octane in the other portfolios, such as dividend growth and high income. Not to take anything away from Table 13. So, very few people ask us what I think is the million-dollar question. The million-dollar question is, how is it that we've managed to deliver superior risk-adjusted returns in a low-interest rate environment, a low-growth environment, and a highly volatile environment? I think for the new people in the room that are here today, and for many of you that just trust me, thank you for that. And I know you just rather get back to your wine and, don't worry about this, but I just feel the need to tell you, you know what I'm like after all these years? Well, let me tell you, the way that we outperform, number one, and this outperformance could not have happened unless I left CIBC Wood Gundy. Because Scotia McLeod gave me the permission to write my own investment policy statements. I got to choose how your money was managed by each and every manager. And I wanted to protect you. I wanted to protect everybody in this room. Okay, so let's talk about the investment policy statement just very quickly. A lot of you get this. Almost every investment manager in Canada, from the bank's investment policy statement, says that you can only go to 10% cash. We can go from 30 to 60 in our mandates. Investment policy statements drafted by banks say that you have to be 8 in 8 out of the 10 subsectors. There is 10 subsectors on the Toronto Stock Exchange. Healthcare, base metals, technology, telecommunications, financials. So if I'm working under an IPS statement written by a bank and I dislike financials, I dislike base metals, and I dislike healthcare, guess what? I still got to own one. Does that make sense to anybody in this room? No, but it gets worse. It so gets worse. Because what the investment policy statements of the banks say is that you have to be plus or minus 3 to 5% of that index. So, if you love banks, you can be at 35. If you hate banks, you have to be at 25. We don't manage your money that way. That's how we outperform. We outperformed because last year, for 9 months, you had a 0% weighting in bank. That is a big, big difference. And I'm sorry, folks, but if some crazy person flies into a building, it doesn't take a rocket scientist too much to figure out that the stock market is going down. In the IPS statement that was written by the bank, all they can do is go to defensive sectors. They will sell the commodity-based sectors, and they'll go to utilities, telecoms, and banks to protect you on the downside. I suggest to you, when the market dropped 35% in 2008, did it work for us? No. No one's ever asked me what was the pivotal moment why I left. Well, because I couldn't stand up here any longer after 2008 with these investment policy statements written by CIBC Bank. They're no different at Scotia McLeod either, John, just so you know. I couldn't take that anymore because you can't add alpha. You can't add additional return over and above the market if you are the market. And the investment policy statements that are governing 95% of the assets in Canada are so restrictive, and they don't protect you as an investor, and they don't add any value. And that's why the lion's share of them never outperform the market. And here's what they do. They still believe in buy, hold, and prosper. Well, I can tell you, you can tell me, that buy, hold, and prosper is dead. It may have worked years ago, but it doesn't work today. And I don't have to go farther than the Royal Bank as an example. Because you can make way more money if you trade that stock rather than you hold on to it forever. Because I can tell you one thing, whoever held that stock for the last 12 months certainly isn't up over 20% like everybody in this room. You need to make a macro call. You have to be proactive rather than reactive. And you can't be afraid to be wrong. If this was an exact science, well, I'd probably still be standing here because I love what I do. But it's not an exact science. But you got to pay us to make a call. People on this room came in and say, well, what's your call for this year? I'm going to get into that. It's the exact same call that I had last year. The only difference I firmly believe is all the gains in this year will come in the beginning part of the year, and I'm going to be making an aggressive stance to raise levels of cash as we get in the last half of the year, and I'll explain why. You got to hold managers to their buy and sell disciplines. Why did I fire Foyston? Number one reason. They bought RIM at $40-something. They averaged down 5 times. Some people I sent out there, they wanted to know about RIM. They kept saying, why did they average down? Well, when they sold it at $6.50, I was in shock. So, yes, it's down 20% from where it was at $17 the other day, but it's still more than double from where they sold it. And why did they buy it in the first place? It doesn't pay a dividend. I've always said one thing to you that's been repetitious for 3 years in a row, and we got it right, is that dividends would represent a disproportionate amount of your total return. True? And it's happened 3 years running. I'm sorry, but we have boring Bell Canada Enterprises. They just increased their dividend by 6 cents, $2.33. Okay? And since 2005 that you've all owned it, they've increased that dividend by 95%. Sometimes boring works. Your dividend growth mandate has a dividend yield of over 5%. With bond yields under 2%, that's looking pretty sweet. I'm sorry, Manitoba Tel, it is boring. I agree. But it's working. Okay? We have also had, it's great. You have to make a macro call, but you got to make a bottom-up call. And you got to get the stocks right. And I think we've done a really good job of that over the last 3 years. There's a cardinal rule. Never fall in love with a stock, and never be afraid to fire a manager. We had Foyston for over 12 years. They're really nice people. I've been with you, a lot of you, for almost close to 30 years. I fired them with a lot of grace. I thank them very much for the returns over the years, but I felt strongly we had to part our way. So I can tell you, I never fall in love with the stock, and I never fall in love with the manager. That's why we hired Wayne Wischel at Genesis to manage the Verus Canadian Strategic Value and the Verus US Opportunities. You can see here, what do I like? I love boutiques. I love getting away from the big firms. Okay? Foyston manages $14 billion. Wayne Wischel and his group down on West Hastings manage $1.2 billion. Here's some of the local charities and colleges that they manage money for. What else do I like? And I'll be honest with you. I do the due diligence trip on every one of our managers twice a year. I get updates monthly, quarterly, and then I do an eyeball-to-eyeball meeting with them, because when you look eyeball to eyeball, if they're throwing you BS, you know. Okay? What I like is, the younger I get, the more I dislike getting on an airplane and going to Toronto. So when I can walk out my office door down 4 blocks to West Hastings and look at Wayne Wischel in the eye, I like that. Okay? We are a big fish in yet another small pond. The IPS statement has 2 slight modifications. Okay? We now have a concentrated portfolio of 10 to 25 names. It used to be 12 to 25. I'll explain why we dropped it to 10 in a minute. And part of that reason is because the cash weighting in the portfolio now, we can raise up to 60% of the portfolio in cash. So if we think there's a lot of craziness going on in the markets today and valuations are getting stretched, and we're contrarians because everybody else is throwing all the money into the market, we can raise high levels of cash to protect you on the downside. One of the things that impressed me the most was the back testing. I went out and looked at 8 different managers before I selected Wayne Wischel at Genesis. What they did is they went back and they back tested our investment policy statement with their 8 proprietary models that they use to gauge the economy and to help pick them stocks. And they came back and they back tested and showed you and convinced us that this back testing was right, and it showed a huge outperformance. One of those reasons was their ability to go to cash. I don't like this chart because I don't really think it really highlights the fact that you can see them going to cash in 2007, 2008, back to 0, and then back up to over close to 35%. And when did they get back in? For those of you in the back that there's not a chance you can read this, they got back in April of 2009. Sorry, they missed it by 21 days. So, significant. You got to be with a manager that makes the call. We changed the investment policy statement for Foyston. They stayed in 30% cash for an entire year and did nothing. That's why we fired them. You take a look at the US mandate, back tested. Very important. Look at that spike when they raised cash. Raised cash. Over 60% of the portfolio right here at the end of 2008, boom, and invest it right back at the perfect time. There's no guarantee that Wayne Wischel will be able to pull that rabbit out of the hat again, but at least he has experience doing it. So we get a lot of questions about the anchor managed mutual funds, and there's a lot of confusion in the room. Okay? Because as you know, in 2004, I wrote a book called Winning with Integrity, which I sent to every one of you, which none of you read. Thank you. No, I'm serious about that. Mrs. Legals, did you read it? Oh, thank you so much. Thank you so much. You're the first. God, I love that. Somebody read it. Whew. So, you know what I think about mutual funds? I hate them. I hate them. They don't make anybody money but the managers and the companies selling them. So then, 2 summers ago, I decided to update that book that's now on the floor into our SMA guide, and I made it nice and short and nice and simple in the efforts that you might read this one. But I know you trust me so much that you didn't read that either. So you're wondering, how is it then that you own mutual funds in your tax-free savings account, your kids' RESP, and your kids' trust accounts? You're wondering why. Okay, let me explain. Every one of your separately accounts mandates like Verus Dividend Growth, you all have more than $100,000 in that. That is the minimum. Your tax-free saving account, you've only been able to put in $5,000 a year. It's now been increased to $5,500. So what did I do with that money for the first 4 years? I put it in XDV, right? I simply had to find a vehicle that had a low management fee that was going to give me some type of representation of what the stock market was going to do with the 30 highest yielding blue chip stocks. It worked for a while until we got into 2011, and the stock market actually dropped 9%, and our high income did 17%. So we had so much success with Verus High Income, Verus Defensive Income, and our VDIV, that the firm said, we'll let you make this into a mutual fund. I said, great idea. Okay? Why is it a great idea? Because how else am I going to invest your money that's less than $100,000? How can I give your children, how can I give their educational plan the same returns that I'm giving you? Well, we did it by making sure that the mutual fund has the exact same investment policy statement as the separately managed account that you all own, that the stocks are identical, and the performance is identical. So there's only one difference. With the mutual fund, It's unitized. It means you're in there with everybody else. We're all in this together. You can't see the stocks that are in there. But you know the stocks that are in there because you hold the other mandates. You're going to get the exact same performance. So all of those are off to a great start. The fee gets confusing for a lot of you. It has a fee of 2%. For most of you, you're paying 1% outside and 1% inside. Okay? Because if you hold it in a cash account, I can write the 1% off so your fee becomes cheaper. Okay? We're very, very aware of what we can do to make sure we minimize your fees, and in every opportunity, we put them in accounts that you can write off that fee. So those are working out brilliantly, okay? Because we designed them, okay? They're very different than the average mutual fund on the street today. So I'm going to go over in 15 minutes. I'm going to give you a quick outlook on what we see and what we said in 2012. We said that debt levels would remain obstacles to growth in many countries. Continued financial and political volatility in Europe may also continue. We highlighted 3 key points. Declining business and consumer confidence because of that main point. 2, slower economic growth rates. And 3, prolonged periods of low interest rates. So, in a nutshell, what are we saying for 2013? The exact same thing. You can go back to your wine. I can leave now. Everything's good. Okay? It's going to be the exact same thing, folks. The problems haven't gone away. They have not gone away. And you just have to get good at making money in a low interest rate, low growth environment, and a highly volatile environment. And I think we've proved to you that we can do that in the last 3 years. But look what's going on. Have they really addressed all the fiscal cliff issues? Not a chance. It's been pushed off to March 1. Still going to be an overhang on the market. How about the debt ceiling? $16.5 trillion. That's a bit of a problem, folks. Bit of a problem. How about Japan? You got to love Japan. Our economy's been in the tank for so long. Let's get a new prime minister and let's create inflation. Let's grow ourselves out of this. Yen falls 14%. All the manufacturers in the world are going to produce goods and services in Japan that are exporting go, fantastic. Is Greece okay now? Spain okay? How long can you print money for before it becomes a challenge? So you may feel good when you open your envelopes. I'm just here to rein in your expectations. I'm just here today to rein in your expectations. I honestly don't believe it is repeatable of what we've done in the last 3 years, what we can do going forward. I believe that we are going to be able to deliver medium to single-digit returns. And that's as good as it's going to get in this environment. Corporations are still flush with cash and making lots of money, but if GDP is starting to head down and economies are actually slowing, it's going to have its toll. So if you take a look at the US economy, in the 4th quarter of last year, it was actually negative by 8 basis points. In the 3rd quarter, it was 3.1. Now, a lot of that blip in the 4th quarter of last year can be attributed to the bad weather in the United States, but the fact remains is that GDP in the United States today is 2.2%. Okay? And China, you can see, and it's harder to see here, but you're going to see, this is 2013, the light blue, which in most cases is slightly lower than it was last year. So the problems haven't gone away. They're there. They're going to come front and center. Okay? Who would have thought the S&P 500 today would be at 1,500? Would you? No? Darcy, I don't think so. No. I don't think so. Up 38% from the low, trading at 15 times multiple. The Toronto Stock Exchange is trading at a 15 times multiple. There's a big difference, though. Toronto's only up 3.4% in the last 12 months. The US is up almost 14%. And they're still trading at the same multiple. So it's not easy. China's not going away. But they're going to have an effect on our commodity prices. We just think they're going to get into a period of flat GDP going out over the next 5 years. Okay? Everybody says that China's going to roll over. We don't think so. So we're not calling for any significant correction in the market because money has to find a home today. That's the big challenge. Because there is no inflation. I don't care where you look. Look at Japan. As I said, they're trying to manufacture inflation. There's a lot of people in the deflation camp. If you're a gold buff, you love inflation. We just don't see it in the cards. One of the big positives for the US economy is the fact that it is clearly evident that the housing market in the United States is recovering. Gone are the days where you can go and get a condo for $120,000 on the golf course in Arizona or Palm Desert. Gone. Okay, they're $200 now. They're $220 now. Okay? So if you take a look at new home sales inventory in existing, this is a significant decline. I love this next chart as a chart junkie. Got to explain it. Look at the housing starts. Look at the big uptick in housing starts. That's going to help the US economy. What is it going to do is it's going to create jobs. This red line is unemployment. Okay? It's inverted. You okay with that? I know you are. It's inverted. They're just trying to show the correlation. What does it look like relative to housing starts? If you want me to explain it, just turn the red line upside down. And if you do that, it will clearly show that unemployment is going down, not up. That's a good thing. Did I explain that okay? Megan is at school today. She apologizes for not being able to be here. She said, Ken, you're going to have a tough time with this one. Okay, I can explain it later if anybody needs to. So if we believe that there's no inflation, we believe that world GDP is only going to be 3.3%, we can't be overly optimistic that commodity prices are going to run around and head significantly higher. So we believe oil and gold is going to be range bound. I've always been a $100 oil guy, and I'm still a $100 oil guy today. And obviously there is a direct correlation between our commodities and the C dollar. We're just about perfect parity today. Everybody's going on spring break, so I get the calls. Should I convert today? I don't know. Should you? I'd say convert whenever you're going away. Because it isn't going to make a real difference because we believe the Canadian dollar is going to be in a very narrow band. Whether it's 101, 102, 103, anybody's guess. But it's going to be in a narrow, very narrow band. And the only thing I think that's interesting this is the peso. You can see the consensus view of the street, and you can see Scotia's view. They have significant views of the peso. I'll be honest with you, I pay zero attention to that. I pay attention to this. This guy here, David Rosenberg, has been the biggest bear on the street. He's now saying to you, what are you going to do with your cash? He wants you to say, hey, it's time to invest that cash. Okay? Because he's been a bear for so long and he was wrong for so long. And if you could have seen what he looked like when he was a bear, he looks pretty good now. Okay? Pays to be bullish sometimes, even though I'm not bullish. Okay? But it does. So what he's saying is true. How can cash be king? You're getting nothing in your bank account. Bond prices are vulnerable to the inevitable rising interest rate environment. And you got to put that cash to work. And we've been putting that cash to work for you in dividends for the last 3 years. I always love clients that come into these seminars armed and dangerous. They always come in and say, Mr. Wong, Ken, I love you, by the way. Have you read this? Have you read this? No, I haven't, Stephen, but there's his face. Okay, same guy. Mr. Schilling, okay, former chief economist, Merrill Lynch. Okay, so I'm with you. We're so on the same page because you want to say, you're telling us to sell all your bonds. And I told you to sell all your bonds, get rid of all your bonds in October of last year. And this bright man is telling you to keep your bonds. Okay. I'm just telling you that Mr. Schilling, who's a bright man, young man, I think he's got it dead wrong this time. Because he's not getting off his bear stance. David Rosenberg, on the other hand, finally said, you know what, I've been wrong for so long, I better lose some weight and get bullish. Worked for him. Gustin Sheff, let's put him on BNN. This guy's not on BNN. This guy makes you want to jump off a cliff. Okay? And with all due respect to the first formal chief economist at Merrill Lynch, Mr. Schilling, he thinks that everything is going to revert to the mean. Please don't let me explain that one. He thinks that he's back-tested all of his data, and his data goes back to 1890. Pardon the English, but holy shit. That's a long time to back-test the data. And I'm sorry, the last time I checked, you can't manage money by looking in the rear-view mirror. So yes, he made a ton of money in the 80s. Interest rates were 18.5%, and he filled his boots with strip coupons back in the 80s, and he won big. And 3 years ago, he said the Fed fund rate was going to zero, and nobody believed him, and he filled his boots one more time, and he's made a gazillion dollars. Congratulations, Mr. Schilling. But now, he says, housing market not going to recover. Unemployment, disaster. Fiscal cliff, disaster. I would hate to be his wife, waking up to him every single morning. Because everything's a disaster in this man's opinion. But at some point in time, I got to believe that this man's going to be wrong. Because if you take a look at last year, 1 month Treasury bills were 73 basis points. Now they're 91. And you can see on the short end of the curve, rates are slowly rising. It is inevitable that interest rates are going to rise. So Mr. Schilling, bright man that he is, he says, well, I won't own 30-year bonds anymore. I'll just own 10-year bonds. Well, I say he's going to be wrong. Finished in 4 minutes. Okay. Sorry for the educational lesson on how bonds work. Sorry to bore a few of you. But I feel a need to go over this one more time. I haven't brought this out of the toolbox for about 5 years. Had to dust this one, the chart, this one off. Hence, the interest rates on the right-hand side, 8.5%. Wouldn't we love that? God, just put all your money in bonds and then go on a sabbatical for a couple of years. You'd be okay with that, Mrs. Trumbler, wouldn't you? Come to Hawaii, see me? That'll be good. Perfect. Okay, let's explain the bond market. Okay, it's not the easiest understood vehicle. Okay, so Darlene, sorry, I'm going to use you for this one. She decides that she's got $100,000, and this was a number of years ago. And she decides to go out and buy a bond that's trading at par, parity, 100. And she's getting an interest rate of 8%. Well, several years pass. Could be a 10-year bond, 15-year bond, 20-year bond. Several years pass. Darlene decides that she wants to buy a cottage on an island and use this as a down payment. So in the meantime, interest rates have gone from 8% down to less than 2 today. I would love Darlene's 8%. And I'd like her to give it to me for $100,000. You think she's going to do it? Not a chance she is. So when interest rates go down, the price of bonds go up. So, interest rates in the last 8 years have gone straight. I'm looking for some audience participation, please. Down. Therefore, bond prices have gone how high? Okay. So, does anybody in this room disagree with this statement? Interest rates can tread sideways for a period of time, i.e., could be 6, could be 12, could be 18 months. But inevitably, interest rates have to rise, and there's no way that interest rates can go down. Does anybody believe that? Not believe that? Perfect. Okay, so now let's do the reversed. I'm crazy enough to buy a bond, $100,000 today, and I can get a whopping 2%. So I say, great. I want to sell my bond in 10 years' time. Okay? So interest rates, okay? You're making a bet that sometime in the next 10 years, 15 years, or 30 years, that interest rates won't rise above 2%. We don't bet in this room, but does anybody want to take a bet with me right now that interest rates won't rise above 2% in 5, 10, 15, 20 years? Like, I'll give you so many odds it's not funny. Okay? Because we all know that rates are going up and bond prices, therefore, are going down. And they're going down big time. And that is why I believe Mr. Schilling is wrong. And Scotia McLeod, you can keep this in, please, John. John, you with me? Scotia McLeod's going to be right on this one. Okay? You can clearly see here. Okay, you can't clearly see here. Let me help you out. Is that we are forecasting that a 30-year Government of Canada bond will lose 13% in 2013. And the consensus view, what everybody else thinks, is down 7.5%. And we think every bond duration is going to lose money, and so does the street, for every single bond, unless you're under 2 years. And if you're holding a 2-year bond, a 2-year Canada, total return, 1.66%. So, here's the problem here, is that there's 1,400 pension plans in Canada today, and now we've got a situation where 125 of them are on the watch list. Why? Because of low interest rates and dismal stock market returns. So how are corporations going to fund their pension liabilities? One, they can put more of their profits in. Do you think they like to do that? No. Of course they don't. So how are they going to do this? They're going to take their risk portfolio, their risk tolerance, and move it farther out. They're going to have to get riskier, and they're going to have to own more equities to meet future obligations. What is my number one concern today? My number one concern is that people, retailer investors, are finally catching on. They're selling their bonds at an alarming rate. And what are they doing with that money? They're putting it in the stock market, hence the 40% rise. So, if we look in the first week of January 2013, Americans put $18.4 billion into U.S. equity mutual funds. The largest number since 1992. I don't like that. I'm a contrarian. When they're in, we're out. In the first 5 weeks of this year, Americans have put in close to $30 billion. And that number has never been greater since April of 2000. And we all know what happened in 2000. So, the one lesson that we've learned in all these years together is that the trend is your friend. And right now, there's an incredible amount of momentum getting this stock market moving forward. Well, we want to be there today, and we want to participate. But I can assure you that come the end of the second quarter, or if we get signs earlier, we are going to move to cash. Because when everybody gets in, I get a little bit worried. Because a lot of the gains, especially in the US, have already been made. The last 30 seconds, I know I can't do this presentation, which commenting on the real estate market. But you know what's really? I'm just looking around the room. I don't think there's one realtor in this room today. Yahoo! Oh, where? Yeah, well, she's retired and she's no longer here. Because she knew I was going to talk about real estate. You know, it's kind of like Mr. Schilling, right? Like you stay a bear for an incredibly long period of time, you're eventually going to be wrong. You know that I had to stand up here for 2 to 3 years and tell you I'm wrong on my call on the Vancouver real estate market. But I certainly don't believe I'm wrong anymore. And if you take a look that it takes 10 times the average income of somebody in Vancouver to buy a house, putting us at the second most expensive place to live in the world, I don't know. Doesn't add up to me. On Family Day, I had to drop off a package. It's being a courier still. It's personal service. To a client that lives in Shaughnessy. I don't get out that way anymore because our office spend most of our time in our downtown office. And the only time I get to that area is I pick my kids up from school. And I can tell you one thing. You want to worry about getting hit? Try and pick your kid up from Point Grey Secondary School at 3:15. Okay, kids, forget it. Cut through the trail, meet me by White Spot. That's the only way you're getting a ride home. Because I'm not going in danger zone. No way. No way. So, I was driving around Shaughnessy. Monday morning, no traffic. I was blown away with what I saw. For sale signs everywhere. Like, I'm not going to Mackenzie Heights and looking at the 50-foot lots. I'm going into Shaughnessy looking at the 250 lots with the gargantuan house that needs to be torn down. And guess what, folks? They're a dime a dozen. Also, all you have to do is go to the Olympics Athletes, the Village. Drive down West 2nd, get to Maine. You go, holy, get me out of here. It's a construction nightmare. A nightmare. So, the key thing is volume always precedes price. Volume always precedes price. Last year, Vancouver real estate, year over year, sales down 31.5%. So far, January 31st, 2013, to January of last year, down 14%. There's a difference between the real estate market and the stock market. In the stock market, we have instant liquidity. If we want to make a call, we can sell today and have your cash in 3 days. The real estate market obviously doesn't give you liquidity, which makes the cycle that much longer. So if you take a look at just Canada, in how many years it took to go from the trough to the peak, and you can see that we're the only country in the world that hasn't topped over yet. And if you don't think that we're going to be different than the US, or more importantly, if we take a look at 21 international markets, which is this black line here, if you think we're any different than anywhere else in the world because we have such a beautiful city to live in, I think it's beautiful, but I encourage any one of you to offer to do me a favor and pick up my kids from Point Grey High School next week. And you tell me whether it's beautiful. So, I'm just saying that this is we're in the first inning of what I view. First inning of a 5-6 year decline. Okay? So, what alarms me? Get a load of this. Canadians, we're so conservative. We're nothing like the Americans. We're very conservative. We now have almost 170% debt to take-home pay. We are reaching the levels seen in the United States in the crisis of 2007, 2008. Look at the increase. Look at Scott. He spends all day long helping people with their debt issues. What's the first thing he does? Cut the credit cards. It's a problem, folks. It's here today. It's not going to get any better. So, I'd like to, needless to say, I didn't create the chart. I just said, give me an idea. I got this idea. I would have been, if I tried to do this in PowerPoint, you know what? We would have had to have the lunch in like the summer. That's how long it would take me to do that. Yes, and I'll tell you why. I'll tell you why I threw this together. Kirsten, thank you very much for delivering this. I take managing your money very seriously. And I appreciate more than anything you allowing me to drive the bus. Because I want to be the bus driver. You're paying me to be the bus driver. I have 4 clients that still debate with me when I give them a recommendation. And sure, do I like the debate? Yeah. But after an hour discussion, they say, yeah, okay, well, go ahead then. They're not in this room at lunch. So thank you for letting me drive the bus. And when we go through great times, I seem to get all the credit, which is great, because when we go through bad times, I get all the blame. But I really want to thank everyone else in this picture, because when you take a look at Jennifer, when you take a look at Deanna, when you take a look at Cindy, in particular, they provide the Nordstrom level of financial services. They, in my opinion, have done an amazing job of servicing your accounts, and sometimes I don't think they get enough credit, but I just wanted, to those 3 ladies, say thank you very much, because you make it all happen. And because you all make it happen, and when people request checks, we have trained you so well. No one phones me anymore. It's good. You're allowing me to do what I do best. It gives me more time to manage your money. David, I can't thank you enough for making all of these charts happen and all the information, because as I say, these young minds and how they can find the information, it's unbelievable. Kirsten, I can't thank you enough for making all this PowerPoint work for me. Thank you so much for coming. And I do have there are a couple roses left, so if you're in the doghouse, God, it's so good not to be in the doghouse. You guys have stayed around for a long time. It's 2:20. So I'm going to be at the front. If anybody has any questions, I can answer a couple quick ones now, or I can meet you after. But once again, thank you for coming. Happy Valentine's Day. And don't worry, we got this thing under control. And don't forget your envelopes. It's all good news.